We had a little bit of selling in the S&P 500 today, but it's still not the sell-off that we're kind of waiting for. This is now the 20th day in a row without a 1% drop in the S&P 500. That's the longest streak over the past year. Nonetheless, there were some pretty violent movements on an individual stock basis here today. Much of the focus was on Tesla, and Elon Musk had quite the day here on 420 of all days. Of course, his rocket went up into the air and ended up having a little bit of an explosion there, so perhaps not working out the way that he wanted it to. And his stock Tesla was down $17 per share, nearly 10% here today. And we'll actually be talking about that as our trade application example at the end of the video. Of course, we're also going to get into some of our sector analysis. We're going to take a look at our factor selector to see what's been happening from a factor perspective. We'll also take a look at what's been going on with the US dollar, treasury yields, and a lot of other things in another jam-packed session here this evening. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 20th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZ, and we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And let me pull up our S&P 500 heat map here and get a lay of the land. First thing that stands out to me is the chart in the upper right. That is a very bright colored red. And for those of you that didn't catch my 9 at 9 post on Twitter this morning, I felt like it was quite apropos that on 420 of all days, Tesla is the worst performer on the 9 at 9. And it really didn't end very much better than it started. So in other words, a half an hour before the market, it was the worst underperformer within the Russell 3000, I think is what I use, or maybe it's Russell 1000, whatever the index is that I'm using. By the end of the day, the only stock in the S&P 500 that fared worse than Tesla was AT&T, and just by the slimmest of margins. They were both down about 9 or 10%. And so Tesla struggled today with some perception issues as well, or at least Elon Musk did, as of course the world was watching the rocket launch, and it got off the ground. So we got to give them credit for that, but didn't quite have that successful full trip there, and ended up having a little bit of an explosion there. So today was also a day that there was a little controversy on Twitter. So let's just say Elon's probably not having the best of days there. We'll actually talk a little bit more about that a little bit later on in our trade application example. But that one certainly stands out because of how important they are in the market these days. In fact, another thing that I had mentioned, or not mentioned, but noticed here earlier, was that Facebook, or Meta, has overtaken Tesla in terms of rank of market cap as a result of today's 9% drop, nearly 10% drop there for Tesla. So just by the slimmest of margins, Mark Zuckerberg and Facebook/Meta are now slightly bigger than Tesla. Of course, I think Musk has a lot more money than Zuckerberg because of some of the additional businesses he owns and the percentage of the stock he owns and all that kind of stuff. But from a company perspective, Meta is once again larger than Tesla. So that was the one that really kind of stood out to me. The other thing that kind of catches my eye as I look at this is that there is way more red than green on the board. Remember when I was with you on Tuesday, it was basically a split, almost right down the middle. I think it ended up being like 51% to 49%. Today does not strike me as one of those days. It looks clearly to my eye that we have a lot more selling than buying, and that should make sense. Remember, it was a pretty flat performance on Tuesday as well. Today we actually did have a little bit more selling. It wasn't particularly aggressive, but it was down 0.6%. Remember when I was with you on Tuesday, we were counting out out how many days it had been since the S&P 500 had a 1% drop, which is not particularly uncommon, but we happen to be going through a drought in the market from that particular perspective right now. And since I've last been with you, we still haven't had one. So the count is now up to 20 days in a row, 20 trading days now, where the S&P 500 has not dropped even a single percent. And that is the longest streak that we've had in that regard over the past year. So it continues to be one of those almost frustrating types of days, because you almost want to see more excitement. But we just have seen the price activity quite contained for the most part. And, if you got a longer term portfolio and you're just watching them gradually go up, pretty much day after day, or at least week after week, probably not the end of the world. But if you're trying to find some more exciting trades out there, which is probably what caters to a lot of you that watch this video, there it's a little bit more aggravating because you're just not seeing quite as much activity there. Of course, you got your one-offs with the various earnings releases and things like Tesla and all that's going on, but for the most part, the market at large has just been kind of grinding its way higher. In terms of other big movers to the downside, I did notice that Philip Morris also reported their earnings today. That stock was down almost 5%. Schwab was down. Of course, that stock has been in the news quite a bit here over the last month and a half or so. So it was down about 3%. Citigroup was down about 2%. U.S. Bank was down about 3.5%. Truist was down almost 4%. M&T almost 4%. So again, seems like we continue to have those question marks around the banks, particularly the somewhat smaller regional banks seem to be kind of the areas that are struggling right now. Here's a couple of others. Citizens Financial down almost 5%. Zions Bancorp, which is pretty big out here where I live, down almost 5% today as well. So not a good day for the regional banks. In terms of other areas that catch my eye, I would say that oil companies catch my eye. Looks to my eye like all of the oil companies were down today. Let me just zoom in and verify that was the case. Actually, I take that back. And this is interesting as well. I would imagine this is probably as a result of what I shared with you guys on Tuesday, where I was talking about the major upheaval in the global industry classification standard and how a number of stocks were getting swapped into different sectors and industries. Because I know for a fact that Pentair used to be an industrials company, as it is one of those kind of strong dividend growth companies that has a long multi-decade streak of dividend growth out there. So it looks like that is now part of technically the energy equipment and services area. Then again, I think there's something kind of going haywire as I look at this a little bit closer. And the reason I say that is I'm looking up above and I'm now seeing Prologis and American Tower showing up here as well. And those are not energy equipment and services companies. Those are cell phone tower REITs. So I think there's a lot of funny business going on here. The Pentair one I could believe, like if somebody told me that they did change industries, that would make some sense because their end market is a lot of energy companies. They do a lot of pipes and different things like that. But seeing the cell tower REIT companies up here makes me believe that Thinkorswim still is not completely revamped from that major sector and industry overhaul yet. So we better be careful relying too much upon their information. As I go back to the S&P 500 here, you'll notice that Visa and MasterCard and PayPal still don't exist. And most of you probably listened to this on Tuesday, but in case you didn't, those were some of the examples I was using where they're just completely missing right now. Not because they don't exist anymore. Obviously, they're still trading just like they have been for years. But because they changed from the information technology sector to officially being in the financial sector now, it appears as though they've just disappeared off of the heat map here. Remember, I have no control over this. This is from Thinkorswim. I'm just a user of Thinkorswim like you guys are. So if any of you have contacts over at Thinkorswim, tell them to get their act together there and get the sectors and industries all straightened away because it's causing a little confusion out there. Anyway, most of the energy companies, if not all of them, were down today. And that did help me shut down one of the trades that was giving me a little bit of a problem for this video, which was ConocoPhillips. You'll recall that I did I think it was a bear call spread on Conoco, and it really didn't work out the way that I wanted it to, as will be the case quite often. Remember, that's the That's the deal with trading. You got to be willing to take the good with the bad. But anyway, Conoco had gone up beyond the sold strike prices, but here in the last couple of days, I got kind of bailed out here at the last minute. It was going to expire tomorrow anyway, so I chose to shut it down today. Our sold strike was at 105. It closed today just under 104. So obviously, those of you that are still in that trade, if you want to roll the dice and say that, hey, it's going to close either here or lower, you could end up taking max gain on that. I did not. I still took a small gain on it. Nonetheless, I felt reasonably good about that situation, considering that trade was pretty much run over from the get-go, because after I had done the trade, the oil companies got real hot all of a sudden. So it was nice to have, a little bit of sell-off there in some of those oil stocks here to help me bail out on that particular trade. You'll also notice that a lot of technology companies were down today. Of course, technology remains the most important sector out there. However, they did have a reduction in their market cap, as we talked about in Tuesday's session, because, of course, Visa, MasterCard, and PayPal are pretty large market cap companies. And so that entire part of the technology area went into financials. And we found that there were some others like Paychex and automatic data processing that also left technology, but they went to the industrials. So the point is, they did kind of sever off a fairly large chunk of market cap out of technology, but to my knowledge, it will remain the largest and most important sector out there, because of course they still have the big kahunas here of Microsoft and Apple. So technology suffered a little bit here today. We did see that Google managed to close in the green / Alphabet. We did see that Johnson & Johnson, Eli Lilly had reasonably good days. We had a little bit of positivity out of some of those healthcare equipment companies like Stryker and Becton Dickinson. Let's see here. What else? For some reason, the way I said that there a second ago, those of you that know the More Cowbell skit on Saturday Night Live, every time I say Becton Dickinson, I think of Bruce Dickinson. And if you're not following me there, check out the skit. It's pretty funny. But he's I think the record producer that comes in at the end, and he says he's got a fever. All he needs is more cowbell. So anyway, the Bruce Dickinson, or in this case, the Becton Dickinson. All right, enough fun with that. Let's see what was in the green off to the right-hand side here. We did have a number of consumer discretionary stocks that did reasonably well today. Home Depot, TJX, Ross Stores, O'Reilly, Lowe's, AutoZone, DR Horton, Lennar, Pulte, Envy Homes, even Genuine Parts and Liquidators Corporation, along with Whirlpool, they all managed to close in the green today. So there was a little bit of optimism there from a consumer perspective. I should also point out that the casinos did quite well today. That was something else I noticed on the 9 at 9 this morning. Las Vegas Sands up about 3.5% today. Wynn was up about 1.4%. Those have been some pretty strong performers here recently. And as a guy that's been to Vegas here twice in, I think it's the last month, for separate trips, I can tell you that Vegas is still booming, especially the prices there. So be sure that you're willing to spend if you've got a trip to Vegas coming up, because boy, I tell you, the cost of food, restaurants, entertainment, and the hotel rates themselves have skyrocketed compared to a couple of years ago. But nonetheless, people still like that outlet in their life to go and enjoy some good times there in Sin City. So those casino companies perhaps benefiting a little bit from that. Now remember, some of those casino companies have reduced their exposure to Vegas. Some of them have a little bit more exposure globally to Macau, and I even heard the other day Japan is going to be starting up. And so some of these are becoming a little bit more global in nature. Nonetheless, it does seem like the human population is still willing to go and belly up to the blackjack tables and things like that to enjoy themselves. And so that's kind of playing into that theme of travel and experiences there a little bit more. We do own DR Horton in my top-down trend trading class on Monday mornings, so some of you may have some exposure there. So I should point that out as well. They ended up being one of the best performers in the market today. just behind, I think, Snap-on Tools, which I was actually just tweeting about here a moment ago with the dividend stair-step chart on Twitter. So if you're curious what the stair-step chart on Snap-on looks like, feel free to check out my Twitter account. And also Nucor Steel was one of the stronger performers today. It was up about 5.5%. Lam Research also had a good day, and then D.R. Horton was right there in the top 5 best performers today. It's been a little bit of a head scratcher to see how strong the home building stocks have been, despite a lot of difficult economic conditions and macro conditions that are preventing a lot of people from being able to afford homes. It is a little bit of a head scratcher there. Nonetheless, if you look at the charts of the home builders, boy, oh boy, those things are cooking right now. They are very, very strong charts at the moment. Let's go ahead and take a look here at our breadth numbers now. And we'll pull up the Market Watch, Visualization, Index Watch, S&P 500 area. And you can see here the advancers had 172 components, whereas the decliners had 326 components. So that's about a third to 2/3 type of a split that we're looking at there. So it's, again, a different type of a day than what we witnessed on Tuesday, where it was really about a coin flip, 50-50. Today, not so much. It was definitely more of a bearish tilt towards the markets here today. Looking at the charts now, this is chart 4B for those of you that are premium market scholars following along at home with your own charting package. You can see that with today's move, we really didn't change anything in terms of the postures. They're all the exact same as when I was with you on Tuesday. The S&P 500 was down 0.6%, and it closed with yet another bullish, strongly bullish intermediate posture. Remember, it has been either bullish or strongly bullish every single day since May 16th, except for one random day there in the middle where it lost that posture for a single day. But otherwise, if you've been tilting your portfolio based upon what the market forecast technical indicator is telling you, you've done reasonably well with that decision here. And I would say that a lot of people have doubted this move higher. I could very well be one of those because I always have more of a cautious mindset anyway. But I think this market feels to me like it's climbing the wall of worry. It just keeps on grinding higher because there's probably too much cash on the sidelines. There's too many other people being too bearish, and the markets do their best to frustrate as many people as possible. So it's been very interesting to see that the posture using the market forecast has basically been spot on. It was bearish during this bearish time period here. It's been bullish during this full bullish time period here. So for the most part, it's kind of doing its job, what you want to see it do. You'll notice that the moving average color remains green, telling us that price is above a rising moving average. You can see that the Dow Jones Industrial Average was down 0.33% today, so it was the best performer on a relative basis, so obviously still down a touch, but not down as much as the other 3 main indices. It is kind of the same boat as the S&P 500 with a strongly bullish intermediate posture with that green line well into the upper reversal zone, and then the green moving average tells us prices above a rising moving average, a bullish feature. Down below, you'll see the NASDAQ composite was down 0.8%. So it was our worst performer here today. Remember, the NASDAQ has been our leader, so sometimes when we have rather strong moves to the upside from our leaders, they have to give back a little bit more when the overall market goes the opposite direction as it did today. Nonetheless, you can see that we're clearly still above the rising moving average, so the path of least resistance remains to the upside. You can also see that the background color remains strongly bullish. Same thing as the S&P 500. It's been bullish every single day since March 16th, with the exception of one random head fake day there in the middle. This one was really close to giving us a bullish intermediate confirmation signal. Remember, that signal requires the red line to be in the lower reversal zone, and we didn't quite get there by the slimmest of margins. Remember, on the market forecast technical indicator, the lower reversal zone is at 20 even, so 20.00. And you can see here in the label itself, it says it's at 20.39 and falling. So had it just fallen a little bit more, I mean, you can barely, it's a good thing we have that label there, because if you were just trying to eyeball this with a naked eye, you would not be able to see whether that red line was actually in that lower reversal zone or not. It kind of looks like it is, but by the smallest of margins, it stayed out of it, which is kind of a shame, because that would actually be a good example of a more idealized form of that bullish intermediate confirmation signal, because the blue line is kind of where we want it, between 50 and 20. So it's too bad it didn't work out here, but at least gives us a general sense that there has been a little bit of a pullback that we've experienced here lately. And you'll remember that the last time we had an official bullish intermediate confirmation signal was right here on the 12th of April on that candle. And as you can see, that would have been a reasonable time to be buying the dips on some of your favorite companies. And we had a little bit of a push higher there immediately after that. Let's talk about the Russell 2000 now. Remember, this is the one that's been our laggard in the markets here, largely because of what's been going on with the regional banks and the weaker US dollar and things like that. So anyway, as we look at the Russell 2000, it was down today just like the others. It was down 0.54%, so it was the second best performer, I guess you could say, on a relative basis after the Dow Jones, but all four of these indices did lose money here today. You will see that the posture remains weakly bullish. However, we're getting closer to a point where that will turn dark green along with the other three charts, because you can see that the intermediate reading right now is at 44.91. Remember, that just needs to get above 50 for it to be considered strongly bullish and have that darker shading of the background color there. And so I would imagine that there's a pretty decent chance that could occur early next week at some point. I'm not sure it'll get there tomorrow. It could. So if it's a big day tomorrow, if the markets are up, let's say 1% plus, there's a fairly decent chance it would do it in that type of situation. But if the markets were kind of flat or down a little bit, it probably won't be able to quite get there. But early next week, all else being equal, I would assume there's a decent chance that that can occur, assuming there's not some sort of a major meltdown or something like that. So we shall see. But as of right now, weekly bullish posture, and that moving average color remains yellow, unlike the others that are all green. In this case, telling us price is above a falling 30-day moving average, and it is another way for us to identify that the Russell 2000 just is not quite as strong as those other areas. Let's take a look at our three green arrows chart. This is chart 4D for those of you following along at home. And we actually lost our three green arrow signals on all of our charts now. Remember, on Tuesday, that was not the case. But fast forward just a couple of days, and we've seen a couple of days of selling in the case of the S&P 500 and the Dow Jones. They have not been aggressive selling days, but they have been red days nonetheless, and that was enough to push the momentum of the market down in such a way that we now have red arrows creeping in there on the MACD histogram here for the S&P 500. That came in today. We got the same thing over here on the Dow Jones Industrial Average, so that basically now disqualifies that prior three green arrows setup. Now that can change tomorrow, right? If we have a big 1% up day, that arrow could immediately, even the very next day, go back to green. It doesn't happen a lot, but it certainly has happened in the past. So be on the lookout for that possibility. But right now it's telling us that, hey, we've got a little bit of a loss of momentum, and that makes sense. We've had 3 days in a row to the downside for the Dow Jones Industrial Average. In fact, we've had 4 out of the last 5 days to the downside for the Dow. It hasn't felt like it because none of the days have been violent sell-offs. They've all just been whimper sell-offs. Nonetheless, that does wear and tear on a technical indicator like the MACD that's designed to try to track momentum within the market. So anyway, down below we have a red arrow on the NASDAQ in the stochastic reading, and we have the same thing here with the Russell 2000. So with the NASDAQ, it also has a red arrow on the MACD, whereas the Russell 2000 still a green arrow there. So kind of a mixed bag in terms of how the arrows are affecting all 4 of these charts. One thing that does join them all together is they all have green arrows on the moving averages. So in other words, price is above moving averages. That's at least a start, but it's some of the other underlying indicators that could use a little bit more pick-me-up from the bulls here once again. In terms of our longer term chart now, this is our 1040 crossover method chart. You can see here that today's sell-off did not, of course, impact a longer-term chart all that much. Basically, we're looking at the same thing that we have been looking at here in the last week or two, which is we have bullish crossovers, or what they would refer to as golden crosses, on the S&P 500, on the Dow Jones Industrial Average, and on the NASDAQ Composite. In all three of those charts cases, the 10-week moving average, represented by that orange line, has gone up and over the blue line, which is the 40-week moving average, and that is generally perceived bullishly. On the other hand, over here with the Russell 2000, it still has its death cross. It has not yet crossed bullishly yet, but it was in that golden cross mode here, a couple months ago. It just didn't really amount to anything, right? That's what we would call whipsaw there, or chop in the business. It really doesn't help you in that regard. What you want to see is kind of like what we saw back here on the S&P 500. We got this nice golden cross back here in June of 2020. Remember, that was still pretty early on after the COVID crisis. We actually had a good chat about that in my Q&A class here today, talking about one of the trades that I did for you guys in this video at that time on Discover Financial. It happened to raise its dividends here recently. So we were talking about how back here 3 years ago, when I bought calls on it in this very video, I retweeted it the other day if you guys want to go back and listen to my mindset 3 years ago to see what I was thinking about in the midst of COVID there. But anyway, that was a really nice move right out of the gate there in June or that summer of 2020. In the case of Discover Financial, they have since raised their dividend very dramatically. If you go back and listen to that video from 3 years ago, at that time, Discover Financial had a 4.95% dividend yield, which was actually very high for it at the time, which is why I was pointing it out. With all of these dividend increases that have happened along the way, your yield on cost had you bought the stock that day. Now remember, I was presenting long calls, so it was a slightly different situation. But had you decided to buy stock instead of the long calls, your yield on cost today on Discover Financial would be 7.88%. Yes, you heard that right. It's almost crazy to think about at this moment, but that was how strange the situation was for COVID back in the day. And in general, I think that this chart did a pretty good job with the overall market. Did it catch it exactly at the lows in March or April? No, but that's not what it's designed to do. There is always going to be a lag when it comes to moving averages. And the fact that it got you bullish in early June of 2020 and let you ride that entire move all the way till right here in April of 2022 was, I would say, a winning strategy, right? That's where you have the lack of chop and the lack of whipsaws. That's where you're just enjoying the benefits of being long the market. And I would also say that this time period where it went bearish here from April of 2022 until basically earlier this year did its job reasonably well as well. So, what we've been experiencing here more recently has not been quite as fruitful because you're trying to see if it's going to get its footing or not and make an actual directional move. And right now, that's still a big question mark. Whereas these other moves that we've seen in the past have been a little bit more adamant that they were going to head in the direction of where the cross was taking place. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. A reminder that they take a lot of time for David and I to put together. You might not think it because you're only listening to the part that is the part that's the finished product. But each day that we decide to do these videos, it takes at least 3 hours of our time. And remember, we don't have a staff. We're just doing it on our own. And so producing a free video that we don't make money from is not always of the highest priority, although we do understand that many of you do enjoy them to the point where we we do want to get them done for you if we can help it. And we always say the best way that you guys can encourage us to do these videos and help us along with our efforts here is simply by clicking like for us there on Twitter. Try to train yourself to do that each and every time if you can. We have a lot of you that do that, and we appreciate you. It doesn't really take much of an effort on your part to get a lot of effort out of David and I. So as I always say, as long as we're up and over 100 likes, I'm more than happy to do a full-length video for you the next time I'm scheduled to do one, which is why I'm doing a full-length video for you right now, because we got to 106. So not quite as good as what we saw the time before that when we got up to 130. Nonetheless, we did get up into that triple-digit territory, which I certainly appreciate. Let's go ahead and do some shout-outs. Thank you to Richie. Thank you to Fun Jonesy. Thank you to Jim. Thank you to Paul and to Steve and to David and to Lucius and to Ken. By the way, I like that picture you posted there, Ken, of all of your motorcycles. Thank you to my buddy Ian, the OG dividend investor. Thank you to Evan and to Pam and Curdy and Jamie and Norm and NZ and Jim and Valerie and George and Keola and Rich and Business News and Carlisle and Claire and Teresa, TS, Randy, David, Susan, Fred, Angie, Arth, Cynthia, Violina, Greg, Barry, Sarah. The list goes on and on and on. I can't get to all of you, but I certainly appreciate you nonetheless. So thank you. Please keep that up, and we'll do our best to keep up our routine for you as well. Let's now talk about the factor selector tool here. Reminder that this gets updated on Tuesdays, so it is a couple of days stale by now. Remember, our premium members would have access to all of our information in real time, but in this case, it allows me to kind of share some basic rotational things that we are recognizing within the markets, even here during these free videos. But normally, we go through a lot of these statistics and trade off of this in my Wednesday morning factor-based swing trading class. Anyway, as you can see here, once again, quality is leading the way. This is now the 7th week in a row that quality is number one on the factor selector. And a reminder of what we've been talking about during that entire move is that quality is very closely aligned with the technology the technology sector at this moment in time. So quality factor, technology sector, they are kind of joined at the hip right now, with stocks like Apple and Microsoft having very high or strong credit ratings. That would be the types of companies that you would find in the quality ETFs. On the flip side, you can see that we have a brand new dead last position, and that is low size. You'll notice that this has been a long time coming, so it shouldn't be a surprise to you to see this, because of course I've been sharing this with you for the last 2 months as it's been happening right before our eyes. It's kind of an interesting example of a factor that did a full round trip during the 3 months that this rolling 3-month graphic tracks. Just here at the end of February, the low size factor was actually number one. It was the last number one before quality took over, and quality has stayed up there the entire time. Meanwhile, low size has gone all the way from number one all the way to dead last during that time period. And again, from my perspective, why that's happening right now is twofold. First of all, we are seeing that the regional banks are lagging tremendously compared to other industries that are out there. And naturally, you're going to find a lot more regional banks in the low size index than you're going to find something like JP Morgan or Wells Fargo or something like that, right? Those big banks are not going to be in the low size areas, but the regional banks will be. So that is limiting them to a large degree, since we have not seen dramatic snapbacks in those regional banks yet. There might be a handful of them that are, but for the most part, most of the regional banks are way below where they started the year right now. And remember, for the rest of the market, it's the opposite. Many other stocks in the market are close to multi-month, if not yearly, if not all-time highs, right? We've been talking about McDonald's here more recently. And I was joking here with this GIF, and how it feels like all you need to do to become wealthy in the market right now is just hold McDonald's and watch it go to all-time highs day after day after day after day. This was yesterday that I retweeted it from Bar Chart, but they were saying that 17 out of the last 19 days with trading green for McDonald's. So, some of those areas have just been quite legendary, to say the least. Anyway, you're not going to find McDonald's in the low size area, that's for sure. But you could find McDonald's in some of these areas like quality and momentum that are holding up here towards the top a little bit better. So anyway, that's one of the reasons that I think that low size is underperforming, is that they have a way above average exposure to the regional banks compared to the other factors that are out there. And the other thing that I think is affecting them right now is that we really don't have a particularly strong US dollar. In fact, if anything, you could call it weak at the moment. And typically when the US dollar is weak, you get the big multinationals that outperform. And typically when you have a low size factor, you don't have a lot of multinationals there, right? That's where you have a lot of those regional US exclusive banks and, small manufacturers that, are only hanging out in a small niche within the United States, or maybe a bunch of smaller utilities that only have operations in 3 or 4 states in the United States. So you just don't get a lot of international exposure. So when the dollar is weak, you don't get that benefit like you would if you are a McDonald's or, a Procter & Gamble or Coca-Cola or, those types of companies that are doing pretty well here more recently. Even Hershey's, Pepsi, those types of companies have done pretty well here in recent time periods. All right, let's go ahead and now pop back on over here to the Paper Money platform. Let's do some more charting analysis. Let's do chart 5A. This is our asset class 12 grid. And as this pulls up here, kind of a mixed bag in terms of green versus pink, but one thing that does catch my eye is the bottom 2 corners, which is where I oftentimes start this conversation with you guys, have turned green, believe it or not. They don't look like healthy charts, so I'm not personally going to be a big believer in the moves, but I also have to, stay flexible with my mindset and understand that things do change, even if I don't believe that they will in the immediate short term or anything like that. So if there is going to be a trend reversal, it will eventually start with the posture going from strongly bearish to weakly bullish. And that is what we've seen on the US dollar in the lower left and the 10-year US Treasury yield in the lower right. Now remember, I don't really want them to be bullish personally. As a dividend growth investor, most of my companies that I own are multinational, so I actually prefer it when the dollar is weak. Nonetheless, as a long-term investor that plans to hold stocks for years, if not decades, I know there will be plenty of times when the US dollar is weak and plenty of times when it's strong and everything in between. So you just have to kind of take it for what it's worth, and there's not really anything you can do about it. But point is, there has been at least a little bit of stabilization in the US dollar after plotting that oversold cluster signal. So we had this one over here on April 4th that led to 3 straight days of upside. That ended up failing, and you can see we cut through that prior low to form yet another oversold cluster signal, and this one feels like it's been a little bit more resilient. It's about the same probably on a percentage basis in terms of how much it's gone up. It's just that it stayed up for a little bit longer in length, in more days there. The other one failed rather quickly. You'll also notice back here we have some evidence back in late January where the US dollar was also oversold, and it led to a pretty rip-roaring rally to the upside. Can we get another one of those here? Anything's possible, I suppose. We'll have to keep our eye on it. What we saw last time around is that it was about ready to change. The moving average was about ready to change when it crossed up and through it anyway. If that happened tomorrow, that likely would not be the case, because you'll notice that the decline in that 30-day moving average is pretty steep right now. There would be some differences even if it tries to get a little bit more resilient here all of a sudden. So we'll keep our eye on it. Today it was actually flat. You can see that there was a 0.00% move. That's why you have a rare gray candle there. Let me show you that if I maximize it. you can barely make it out because gray does not look all that different than black. But this is a black outline that you're looking at here from yesterday's candle. This one is a gray outline, and gray is very rare because it only occurs when the movement was exactly 0.00. And as you can imagine, that does not happen all that often, right? It can happen. It's kind of like when I was talking about there are two different types of traders on Twitter the other day, and I showed the roulette wheel board that showed you a streak of a bunch of blacks in a row, and asking the question, would you bet on black or would you bet on red on the next one? And it's kind of the idea of, are you a trader that plays into the hot hand, or are you a trader that is reversion to the mean oriented? And anyway, on roulette these days, of course, there aren't 50-50 odds. The casinos might want you to believe that there are because they want your money. Those casinos and skyscrapers in Vegas didn't build themselves. They built themselves off the back of your dollars that you bring to the town. And so, of course, these days, roulette wheels have a zero and oftentimes a double zero. In fact, I think I read something overseas where they were actually using a 000 somewhere. So the house is really trying to tilt the odds into their favor there. So you can kind of think about the gray outline here as happening about as often as the little ball that they spin around on the roulette wheel ends on 0 or double zero. It happens, but it's fairly rare. So anyway, today was one of those rare days where next to nothing happened in the US dollar, but the fact that it didn't just go back down kind of, bodes well for it, because in the past it had reversed lower quite quickly. And right now it's just being a little bit more resilient up there. It's still below the moving average, which is falling. So right now I'm still thinking, this thing probably is going to remain a little bit weaker, but my mind is willing to change very quickly. But what it needs to do is prove it to me, and it needs to get above that moving average and stay above it. Right now, I can't make that claim. So we're in wait and see mode on the US dollar right now, but at least there are finally some signs of life there where the posture itself has changed from strongly bearish to weakly bullish. With the 10-year US Treasury yield, it fell today. And it closed today at 3.54%, obviously well off of those 4% yields that we were talking about here not too long ago. Nonetheless, we've had a pretty big push higher on the 10-year Treasury yield from those oversold cluster signals there on April 6th. That was a pretty violent move that we've seen since that time period. So while today was actually a pretty decent sell-off day for it, because it had some built-in grace period there, or some built-in goodwill, I guess you could say, it could afford to give back a healthier chunk here today because it went up so much to begin with, yet still retain that weekly bullish posture in this case. At least in the case of the 10-year Treasury yield, it's above the moving average, unlike what we're seeing with the US dollar. So maybe there's a little bit more hope that rates can head higher again. Again, I'm not begging for that personally. I would like to see the opposite because a lot of my stocks are interest rate sensitive. So if I had it my way, I would want a weak US dollar and I would want a falling interest rate environment. But obviously, I can't get it my way whenever I want it. I have to just basically take whatever the market is giving me. So it's not that I'm cheerleading this on or anything, but just trying to relay the information on to you. Some of you will have portfolios that are destined to benefit if interest rates go higher. And for those of you that are in that sort of a mindset, there are some constructive signs showing up on the chart. You've got a ways to go. I don't think you want to go too hog wild bullish at this point yet, but at least there is a little bit more optimism here that things are reversing after being in quite an ugly sell-off mode here for much of the last couple of months. Now, with interest rates falling today, no surprise that treasuries themselves rallied. The TLT was up 0.85% today. However, you'll notice it was not enough to change the strongly bearish posture. It is still below its rising moving average in that case as well. You also saw that the foreign bonds also rose today, 0.35% there, but you still have a weekly bearish posture in that case. So it looks a little bit stronger than the treasuries. And then last but not least, you do have high yield bonds that actually fell today. So the other two rose, this one fell, but unlike the other two, this is the only one that's above a rising moving average. So it's kind of one of those weird times where you really have three different kind of vantage points with these three different major bond categories here. A lot of times they're kind of, very correlated to one another. They all kind of look the same, but right now there are some distinctions to be aware of. Down below, in terms of commodities, you did see that gold rose today by 0.39%. It remains above a rising 30-day moving average. So in my vantage point, the path of least resistance remains to the upside for gold. However, the background color is light pink now, telling us that we have a weekly bearish posture. So kind of conflicting signals there right now, and they'll be butting heads here in the next week or so to see which direction it ultimately wants to go. Is it going to remain in an uptrend above that moving average, or is there more selling on the way where we crack below that? So we'll find out together. And then oil, you can see here, had a pretty tough day, so that explains why when we looked at the heat map here a little bit earlier, nearly all, if not all, of the oil companies in the S&P 500 were down today. This is actually the fourth straight sell-off day for oil prices themselves, and the fifth of the last 6 days since plotting this overbought cluster signal in this case. So remember, I talk quite a bit more, it feels like, I don't know if this is the case, but it feels like I talk a lot more about the oversold cluster signals, but every so often, the overbought cluster signals can lead to very nice trade setups as well. For those of you that were willing to fade that move on oil, that would have made a little bit of sense to do it right there. It was right where we had about a double top from where we were back in January, and you also had the overbought cluster signal. Had you had some sort of a short-term bearish trade on oil right there, you'd have done very well for yourself. That's a pretty aggressive sell-off that has taken place since then. Strangely enough, all it's doing is really offsetting the move that took place since the OPEC announcement. Remember, that's what created that huge gap that took place right there. We've now started crashing into that gap. We have not yet completely filled it. It would have to come down here to where the high price was on March 31st. But oddly enough, because this has been such an aggressive move higher, despite what looks like a very violent sell-off here in the last week or so, it still has a strongly bullish posture and is still above its rising moving average at the moment. Although to my eye, it looks like that moving average is starting to flatten out. So it's a possibility that that starts rolling over here as well. It's been a very lumpy chart, to say the least. This has not been a consistent, smooth trending chart. It's been kind of all over the map. So it's been probably a little bit more difficult to trade as a result. Up at the top, you'll notice that EFA closed exactly flat today as well. So there's another one like UUP that you could say the little white ball landed on the green part of the roulette wheel, a fairly rare occurrence where it was exactly flat today with the gray outlined candle right there. But we did hold those gains that we've seen out of EFA, and remember, we're very close to multi-month, if not yearly highs there for EFA. So that's been an area of outperformance for the world. With EEM, it did close lower today, not nearly as badly as the US did. Nonetheless, it did sell off for the third straight day there, and you can see that this one is still trading a lot closer to its 30-day moving average and actually trading in the lower half of its 3-month range, which does make it quite a bit different than EFA, which clearly is in the upper half of the 3-month range. In fact, a stone's throw from 3-month highs. So right now there's a lot more positive bullish momentum within the developed world, think Europe, Japan, Australia, etc., compared to some of those far-flung places, maybe like India, China, Brazil, Mexico. Those nations come to mind that are part of the emerging world right there. Let's take a look now at our sectors. This will be chart 5C for those of you following along at home. And we're back to a clean sweep. How about that? Remember, on Tuesday, we had lost that clean sweep. So 1 week ago when I was with you on Thursday, we had a clean sweep. But then we lost it on Tuesday because real estate went back to that light pink color. But since then, we've had enough of a bounce. Today was actually a sell-off in real estate, but yesterday was a pretty good day. So I guess the net effect of those two things was enough to push that posture back to strongly bullish again. So anyway, not only do we have a clean sweep of bullishness across all 11 sectors, but they're all strongly bullish, right? There's none of those lighter green background colors there. They're all the dark green variety. So I suppose that's a good sign, considering that we've had 2 days in a row of selling in the S&P 500. You would figure that there would be enough damage to send one of these charts at least back to kind of more bearish territory. Even energy, which obviously had a pretty difficult task in front of it. If you saw what we just looked at a moment ago with oil prices basically going straight down in the last week, yes, we've seen energy shares sell off as well, but not as violently as the oil prices themselves. I know that for a fact as well with some of the stocks that I'm tracking for my classes. So anyway, you will see here, notice how we have not yet breached the, well, I guess it depends on how you look at it. There's an air pocket between this candle right here on the 4th and this candle here on the 31st, but technically there was this candle in between it of when that first big OPEC decision was made, and then it kind of settled out that second day. So it kind of depends on where you're looking at the gap. But the point is, from that second day there, we have not yet breached that low. And we almost did it at the lows today, but it kind of bounced from those levels. So anyway, to my eye, it looks like energy stocks have been holding up better than energy/oil itself as a commodity is holding up, for better or for worse. And then you can see that it was pretty much a down day across the board. In fact, I think there was just one up sector, and that happened to be consumer staples. So despite Philip Morris having a difficult day from a consumer staples perspective because of its earnings announcement, most other consumer staples were up enough to offset that. So pretty decent day out of the staples there. So as I mentioned to you guys on Tuesday, that makes me happy because the consumer staples happen to be my largest sector. But remember, that's not any sort of a thing to celebrate necessarily, because that is always the case. Whether the markets are good, bad, or otherwise, the consumer staples are nearly always my largest sector, because as a dividend growth investor, that's where you're going to find the longest dividend streaks in many cases there. So I was happy, I suppose, today with that performance, but I was not happy with what happened to all the other sectors that happened out there that happened to be lower on the day. In terms of who the worst performer was today, let's see. It might have been real estate. Let me just verify with my eyes. Actually, I take that back. It was discretionary. That was the worst performer. It was down 1.54% today. Remember, Tesla is a huge component within XLY. These are the market cap weighted sector ETFs here. They're not equal weighted. So Tesla and Amazon have by far and away the most impact on XLY, and therefore, even though some of the smaller discretionary stocks like D.R. Horton that I talked about earlier, or Las Vegas Sands, or those types of companies, right, there were plenty of discretionary stocks that were in the green today. In fact, it would have been kind of interesting to see the breakdown. We might be able to do it with this visualize area here. I do have a discretionary watch list, but just be aware this is not the S&P 500. This is it goes beyond the S&P 500. Nonetheless, you can kind of see what I'm saying here. The division between advancers and decliners is not overly dramatic here compared to what we see on the charts, where the discretionary area was supposedly the worst. So what that's reflecting is the fact that Tesla was one of the worst performing stocks in the entire S&P 500 today, and it has a much, much bigger impact than basically every other stock in the discretionary sector with the exception of Amazon. That's the only one that can vie for attention alongside of Tesla. So despite there were plenty of stocks in the discretionary area that closed in the green today, they just weren't important enough to offset the really terrible day that Tesla had. And I suppose that's a good enough segue to talk about Tesla some more. So let's do that. I'm going to come on over here to our swing trading chart. This will be chart 3A. And I'm going to pull up chart TSLA. And of course, that is Tesla. And I ended up doing a bearish trade on Tesla here today. And of course, the trade is already done. And I posted that into our Telegram channel that those of you that are premium members have access to. And so what I ended up doing was a bear call spread on Tesla. As you can see, Tesla was down significantly today. This is actually its third straight day to the downside. And in doing so, it had something important that occurred on the chart, which is it broke down below the prior support area. Now, obviously, that doesn't guarantee anything, but it does tell us that the path of least resistance right now appears to be to the downside. You clearly have a lower high, so you have this high over here from February 16th when it touched $217. And obviously you had a lower high a couple of weeks later right here, and you had another lower high right here. It attempted to make a big move on the 31st. It just failed. But even at the height of that candle on the 31st of March, it was still lower than where the prior high was. Right here it got to maybe, I don't know, 207 or so. So clearly below, 217. So in other words, we still have a series of lower highs that we're dealing with here. Before today, we did not have a series of lower lows. We had this very obvious low right here on March 13th when it went as low as about 163, and then it had a recovery. Well, that recovery ultimately failed, and that leaves us with where we're at today. After this company reported their earnings, they have now broken down through that support area right there. So I figured, let's see if there's a bearish trade that I could do. One of the drawbacks is, we have very low volatility right now, so that's not really helping credit sellers out there. We actually had a pretty good example of how volatility can really impact your pricing of options contracts today using T. Rowe Price as our example. We talked that through in my Q&A class earlier today, so feel free to check that out if you're a premium member. But I was talking about how tomorrow the sold put that I did in this video for T. Rowe Price will expire at max gain, and the stock has done absolutely nothing since then. T. Rowe Price, when I placed that trade, happened to be on this day, because I was talking about how I was kicking myself. If I would have waited one day, our pricing would have been even better. But we sold a put on this day right here, and you'll notice the stock is trading almost identically to where it was trading back there. But because I had sold the put, I'm going to make a 100% max gain on that trade. So the alternative would have been, had I bought the stock, I would have basically been break even. I wouldn't have had any sort of benefit or disadvantage. I basically would have been break even. But since I chose to sell a put instead, I'm going to have max gain on that. And then we were looking at other sold put ideas for T. Rowe Price moving forward, also talking about, of course, that they've got an earnings announcement coming up. But what was really interesting about it is that the pricing available on options contracts right now is pitiful compared to what was available back here, because this was during the regional banking crisis when implied volatility was shooting higher, giving us much better credit availability for selling puts back here. We have less opportunistic situations right now because credits just are not very juicy, because all of a sudden we see the VIX has, imploded since then, right? The VIX, when I was doing those trades back here on the 9th, was up here above 20. Now it's down here, at 17. In fact, it almost hit 16 yesterday. So the VIX has come down dramatically. So I'm not necessarily enthusiastic right now to be a seller of premium. But remember, when I do a bear call spread like I did here today with Tesla, you have a slight benefit out of the lower volatility, because you're talking about two different strikes that are involved in the combination of the trade. When I sold the puts on T. Rowe Price, there was just one contract involved. So it was purely benefiting from higher implied volatility at that time. Today, what I did was selling a bear call spread where One of them is a credit when I'm selling the call, but I'm also buying a call. So in a strange way, there's a part of that trade that benefits when volatility has fallen to these lower levels. It's still true. I would prefer to have higher volatility, but it doesn't hurt you as bad as if you're considering selling puts or selling even naked calls, or selling covered calls. Any single leg strategy would hurt you a little bit more. This is not a single leg strategy. I'm doing a multi-leg strategy here with this bear call spread. And what I ended up doing was the June contracts. And I'm not thrilled with the strike prices, but I was able to get a 30% return on risk. What I ended up doing was the 185s to sell and the 190s to buy. And I think I can't even remember what I got. It was around a 30% return on risk. It might have been, right there. So I got probably $1.14 or $1.15 out of them would be my guess. I'd have to go back and check my notes. But anyway, you can always check our Telegram channel. Remember, if you're a premium member, to get the specific details, because I'll show you the screenshots and all that kind of stuff in there. But I think it was like $1.15 is what I got for it. So my break even on the trade would be like $186.15, which would put me approximately in this general vicinity of where the moving average is right now. So basically what I'm hoping for with this trade is that there continues to be selling pressure on the Tesla stock, and it does not go back and do a whipsaw back above that moving average again. If it does, the good news is I have a defined risk trade. I know what my worst case scenario is. But the hope is that now that we've broken support here, that this stock will kind of be stuck in purgatory for the foreseeable future. So anyway, that was the trade that I did here today on 420 of all days. So I'm not sure that Elon would appreciate the fact that I'm doing a bearish trade on his stock here. Nonetheless, since he's the one that's always joking about 420 on Twitter, I thought it was somewhat amusing that we're doing a trade on his company today of all days. Okay, so that's what I had here for you. I hope you guys have an enjoyable weekend. David should be back with you tomorrow, but I'll next see you on Tuesday. Obviously, I'll see our premium members on Monday in two different classes: top-down trend trading in the morning, options for long-term investors in the afternoon. So whenever is the next time I see you, I hope you have a great weekend in between. Remember, if you want me to do another full-length video like this one on Tuesday, then I ask one simple request out of you. Simply click like for me there on Twitter. It'll only take 5 seconds out of your time, and will go a long way for David and I as small business owners as well. So thank you to those of you that commit to doing that as well. Until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.